In this presentation, we will take a look at a fairly comprehensive problem related to the Debt Service Fund, the Capital Project Fund, and government-wide activities. This will be 2 years worth of data. We're going to enter the information for the first year, look at the closing process, and then enter the data for the second year. Our goal will typically be to enter the data into the government-wide activities first, government-wide activity being on the accrual basis, then look at that transaction and think about how it will affect or how we construct the journal entries for the fund accounting side of things. Our first transaction is going to be related to posting the budget for the debt service fund. So in the government-wide activity, we're not going to have any posting for the budget in the debt service fund because the government-wide activity is going to be on an accrual basis, and typically we don't record the budget into the GL on an accrual basis. Next, we're going to take a look at the Capital Projects Fund. We're not going to enter the budgeting activity in the Capital Projects Fund because this budgeting activity is going to be related to the Debt Service Fund. Within the Debt Service Fund, then, we're going to record the budgetary accounts. We will do that with the trial balance on the right side. Recall that the trial balance will be in order. Assets in green, liabilities in orange. The light blue being what would be like the equity section in a for-profit organization. Assets minus liabilities, fund balance here. Dark blue being similar to the income statement type of accounts in a for-profit organization. Those temporary accounts that would close out in a for-profit organization to equity, them closing out here to the fund balance. We're going to record the budget here. So when we think about the budget, that's going to be down in the income statement type of accounts. We're going to have the revenue type of accounts, the expense type of accounts, or expenditure type of accounts, and then the related budgetary accounts related to them. That's going to kind of muddy things up in comparison to normal for-profit accounting. So first we would want to identify those budgetary accounts. We have the estimated revenues. That's going to be a budgetary account because it has estimated in it. When we think of revenues, it has a credit balance. So the estimated revenues is going to have the opposite, or a debit balance. We also have the appropriations down here. It doesn't have the word expense in it, but it's kind of related to the expense or the expenditures. Expenditures having a debit balance, then the budgetary account related to it, the appropriations having a credit balance. And then, of course, we have the difference between the two, which is kind of like the budgetary net income kind of number. It's going to go into the equity section, into the budgetary fund balance. So it's going to look like this. We're going to say that the estimated revenues, we're estimating the revenues to be $210,000 debit for the budgetary revenue account, opposite of what revenue normally is, a credit balance. Then we have the appropriations going on the books as a credit. That's kind of like the expenses or expenditures, and expenses or expenditures having a debit balance, this then having a credit balance. The difference between the two being what we're going to have to record to the budgetary fund balance. If we record this out, then we first have the estimated revenues. So the estimated revenues are going to be up top in estimated revenues, increasing that in the debit direction. Then we have the appropriations. Appropriations are going to be down here. We're going to increase them in the credit direction. And finally, the fund balance up here in the light blue area in the fund balance section, increasing in the credit direction. That, of course, putting us back in balance. Next item, we're going to jump on back to the government-wide activity. We have a transfer from the general fund to the capital project fund. So we have a capital project we're going to be putting together. Remember, a capital project, something like a building, something like a bridge. We're transferring from the general fund to the capital project fund. When we consider the government-wide activity, when we think about the entity as a whole, because it's going from one fund to another, we don't need to record anything on the government-wide level. So this is another area where on the government-wide level as a whole, accrual basis, not going to have anything here. When we consider the Capital Projects Fund, however, we will have a transaction, and of course that transaction will be increasing the cash transferred into the Capital Projects Fund from the general fund. We're not going to be considering the general fund here. We're focusing in on the Capital Project Fund. Note that, of course, the general fund would have basically the mirroring opposite type of transaction, crediting cash, debiting other financing uses, inter-fund transfer out. Here, money's going into the capital project fund, therefore cash going up with a debit. Other side, other financing sources, inter-fund transfer in. Kind of like a revenue account has a credit balance, it's going to go up in a credit type of direction. It's going to be down here in what would be considered more like the income statement accounts in a for-profit organization, increasing what would be similar to a net income type of calculation if it were a for-profit organization. So if we post this out, we're going to say that the cash is going to be increasing up from zero, up in the debit direction. Then the other side is going to be the credit. It's going to be down here in the kind of income statement type accounts, increasing in the credit direction. Next item we're going to have, or we're going to jump over to the debt service fund. And of course, there's no activity in the debt service fund when we consider a transfer from the general fund to the capital projects fund, because we're not dealing with any type of debt activity there. That's going to be used to finance the capital projects. You'll note that, of course, the debt service fund oftentimes is linked to capital projects, because capital projects, long-term projects, are those that often generate debt that we then have to service. But this time, no debt. Transfer from general fund to the capital project fund. Back to the government-wide activity. Next item, we're going to say we paid fees for the project. So now fees have been paid for our capital project. What's going to happen in the government-wide when we think about basically the entity as a whole on an accrual basis, then we're going to debit the construction work in progress. That's going to be like kind of a job cost system, where we're going to basically everything that's going to go into this big project that we're going to construct, a building or a bridge or a road, is going to go into the work in process, an asset account. We're capitalizing it. And then we're going to transfer it to whatever it is that's built, a building, a road, or whatnot, the capital asset. And then the other side, in this case, go into cash. So we're going to say that cash was spent. We're going to say then the asset's going up. Work in process is increasing because we're purchasing an asset, in essence. Although we're piecing it together, we're constructing an asset with the work in process and the capital project. The other side then going to cash. Cash going down in the credit direction. Obviously, there's nothing in cash at the beginning balance. Therefore, we have a negative number. Don't let that throw you off on the cash side. We're back in balance here, of course. Debits equaling the credits. If we then consider the capital project fund, we're going to have a similar type of transaction, but I'm going to go back to the general fund. Note, if we go back to the capital project fund, we're not going to have the construction work in process, because the government-wide activities on accrual basis, and therefore have those long-term assets. In the capital project fund, modified accrual don't have that. Therefore, the debit's going to have to go somewhere else. Where's it going to go? Construction expenditure. That should look funny because we're building like a bridge, which you think would be like an asset type of account. But we're recording the flow, the activity that's happening in the capital project fund. Therefore, we're recording it in those temporary accounts. Therefore, we're going to debit the construction expenditure, that going up in the debit direction. Other side going to cash. Cash then going down, and that'll put us, of course, back in balance. The debt service fund, no transaction within the debt service fund. We didn't incur any debt. We're simply paying off part of the construction project at that time. Back to the government-wide activities, contractor awarded construction project. So now we're the government, we're building a bridge and whatnot, or a building or some kind of capital project. We got a contractor. We said, contractor, we're going to sign this agreement with you. You're the one that's awarded this contract. Big deal. That's a big deal. However, not typically a financial transaction happening. It's similar to like when we have a purchase order, sending out a purchase order. We haven't received the inventory. We haven't paid for the inventory. No financial transaction at that point in time, although we will track the purchase order typically in a for-profit organization. Here, same thing. We got a contractor. We've hired the contractor. It's a big deal. It's a big contract, but nothing has been paid. Nothing has been started. And therefore, there's nothing to record in terms of accrual accounting. So nothing on the government-wide level. However, when we think about the capital projects level, we do want to record something. Why? We want to be transparent. We want to say, hey, we've got a contractor that's going to be doing the project. We've signed this. We're actually going to post it to the general ledger so you can see it there. Well, how are we going to do that? Well, we're going to have this other account, encumbrances, that is going to be kind of like a holding account for the expenditures. We're going to put it into encumbrances until the point in time that we can record the expenditure at the point in time when expenditures are recorded under the accrual, or in this case, modified accrual basis. So we're going to debit it rather than expenditures or expense encumbrances. We're going to credit something. We can't credit a payable. We don't owe anything yet, so we just make up the other account, which is going to be in what would be similar to the equity section, the holding account. This is just a holding account, that being encumbrances outstanding. So if we record this, then we're going to say that we're going to debit encumbrances increasing in the debit direction. The other side then going to encumbrances outstanding, increasing encumbrances outstanding in the credit direction. We're going to have to reverse this exactly when we actually can record the expenditures at the point in time that they have been incurred. What happens with the debt service fund? Again, nothing happens to the debt service fund. We haven't taken out any debt. We may need some debt in the future because that seemed like a lot to pay, but we don't owe anything yet. Therefore, no debt. Back to the government-wide activity, next transaction, we're going to say that we issued serial bonds. So we're going to issue serial bonds. We're going to sell them at 104, meaning we're going to sell them at a premium or 104%. Interest is going to be 4% on them. Government-wide activities, this should look familiar for kind of bond issuances. So we're going to say that the cash is going to be going up. Bonds payable goes on the books for the face amount of the bonds. Here's the face amount of the bonds. That's what the bonds are going on the books for. We're going to sell them at a premium of 104, so the 1600000 times 1.04. That's what we're going to receive. We got more money than the face amount of the bonds. Therefore, the difference is a premium as opposed to a discount. If we got less money than we sold them for, it would then be a discount. And that's going to be our transaction. This is normal kind of accrual type of accounting. We're going to say that the cash is going to go up. So we're going to increase the cash. The other side is going to go to bonds payable. So here's the bonds payable. It's going on the books as a liability. And then we have the premium on the bonds payable. So then we want to think about, well, what's going to happen to the other two funds? What's going to happen on the fund side of things? Now we do have a debt kind of thing happening here. We've got a debt going on the books. And we got the bond for the capital project. So we're going to have to finance the bond in the debt service fund, and of course this money is going into the capital projects fund. Now, how much is going into the capital projects fund? Typically, we're going to be putting in the face amount of the bond or the lesser of the face amount or the amount of cash we got. We issued it at a premium, therefore the lesser is the face amount as opposed to the cash we got. If we issued it at a discount, we would have to put it on there for the cash we got because that's all we got, so that's what we would transfer. So here we're going to issue it for the face amount. The other amount is going to go into the debt service fund to finance the debt because that's in essence the interest that we're going to have to finance on the debt. So if you think about this and we piece it together in the two funds, neither fund is going to have a payable on it or the premium on it because those are long-term liabilities. Those are going to be on the government-wide activities, not on the fund activity. The fund activity being on a modified accrual basis as opposed to the accrual basis in the government-wide activity. So if we consider the capital project fund, then we're going to say the cash is going on the books for the face amount, the $1,600,000. The credit then going to other financing sources, which should look kind of unusual because again, you would think it would be like a liability. We're going to put it, it's not going to go to bonds payable. It's going on other financing sources because we're measuring like the flow, the financing of the capital project fund. So it's going to be down here in kind of like the income statement type of accounts. So we've got cash then. Cash is going to be debited. Other side going to other financing sources. So other financing sources in the credit direction. What's going to happen to the debt service fund? Well, the debt service fund, we're going to put on the books the amount kind of related to the interest, the cash for the premium. So the cash related to the premium we got is going to go into the debt service fund. Why? Because it's going to be used to service the payment of the debt, which is basically the interest on it. So we're going to debit the cash in the debt service fund, and the other side is going to go to the other financing sources, proceeds on the bonds. So this is the full thing that you see the bonds on the books with the government-wide activity. If you piece it apart and take it apart and consider, as we are here, the debt service fund and the capital projects fund, you can then kind of put these journal entries together and they'll make sense, right? How much is going to go into the capital project? How much is going to go into the debt service? It should basically add up and be in alignment with the government-wide type of activities. So here, once again, we're not going to put the liability on the books, even though it's the debt service fund. We're not tracking the long-term debt. It's going to be on the government-wide activity. We're tracking basically, in essence, the financing here. So cash, in this case, going up, and the other side going to other financing sources, kind of like an income statement account going up with a credit balance. The next thing we're going to do is assume that this amount wasn't included in the budgetary information. So when we recorded the budget for the estimated revenues and the appropriation, the budgetary fund balance, we didn't record or include this amount. So what we're going to do is basically just adjust the budgetary accounts to include it now that we know about it. So to do that, we're going to do a similar type of transaction. We're going to put debit the estimated other financing sources. So remember, when we think about other financing sources, it's kind of like a revenue account. It's going to have a credit balance. When we consider the estimated amount, it's going to be the opposite of budgetary account. It's going to have a debit balance. The other side then is going to go to the budgetary fund balance. So we're going to record the other side to the budgetary fund balance to adjust the budget for this amount that wasn't included but is now being done. So if we then adjust the budget, we're going to say that the estimated other financing sources going up in the debit direction, and we have the budgetary fund balance then being adjusted as well. Next transaction, we're going to go back to the government-wide activities, where we paid the utility fund for project from the capital project fund. So what we're going to do is we're going to say we have the utilities fund, part of the government, servicing part of the capital project. We're going to pay for the capital project, for the building, the bridge, the thing we're making, to the utility, which is part of the government, the utility fund. So this is kind of an inter-fund transaction. You would think, well, maybe we wouldn't put it on the government-wide activities, but we are going to record it, and part of the reason is because this isn't just going to be a transfer from one fund to the other. When we think about the utility fund, we're thinking about a proprietary fund. We're thinking about one that basically does services in a similar fashion as a for-profit type of organization, and therefore we're going to record this on the government-wide activities to show that information. So we have the construction work in process is going to be increasing. That's going to be the asset that we're putting together, the building, the bridge, whatever it is we're making. And the other side is going to be going to cash on the government-wide activities. Then we want to consider on the fund activities, of course, the construction project is going to be in the capital project fund. We're not going to be taking a look at the utility fund, but of course the utility fund will have the transaction there as well. If we post this one out, we've got the work in process. That's going to be the thing that we're making going up. And of course, cashed, what we paid, going down with the credit, those two putting us back in balance. Capital project fund, then, we're going to say similar transaction. Cash is decreasing. However, the other side going to construction expenditures, not going to the assets. We're on the modified accrual basis. We don't have the long-term assets here. We're calculating or tracking the flow of the activity down here in more of the kind of like revenue type of accounts, the temporary accounts. So we're going to say that the cash is decreasing. Other side going to the construction expenditures down below. What about the debt service fund? Nothing's happening to the debt service fund here. We're not dealing with any debt issues. So we're going to go back to the government-wide activities again. We're going to say that we're going to pay interest on the bonds payable. So you'll recall that we have the bonds on the books here. We're going to make the payment on it. Now I'm going to give the fact that we have the premium. This is going to be how much the premium is going to be reduced by. And then we'll go through the payment amount is going to be the $32,000. So the payment that we're going to pay, $32,000. We're going to break that out between a reduction in the premium. So the premium is going to be reduced here, and the rest is going to be the interest that's going to be reduced. What's not going to happen, because it's a bond, is we're not reducing basically the principal of the bond. This face amount of the bond is going to stay on the books. We're going to be reducing the premium, and we're going to be recording the interest. This is kind of like a standard transaction when we make the payment on the bonds. So if we record that, then we're going to say the cash is going to go down. So we're decreasing the cash. The premium is going to go down. We're decreasing the premium. Nothing's happening to the face amount of the bond, and the rest is going to go to the expense, interest expense. So we're decreasing the interest expense. And then we would consider, well, what's going to happen to the fund side of things? This is going to be a debt now, so we can consider this probably going to be dealing with the debt service fund then. So we'll be going to the debt service fund. However, we won't have the premium being dealt with because that's going to be up here in basically part of the long-term liabilities, kind of part of bonds payable. So there's going to have to be some other transaction related to that, although you would think we would be recording the cash decreasing. So if we look at the capital projects fund, although this debt is for the capital project, we're not recording anything in the capital project. We're taking a look at the debt service fund. Within the debt service fund, we're going to record the full $32,000 credit cash we paid, but we're not breaking it out between the reduction in the premium because we're just going to record it all as interest here. So it's all interest here. It's all on what would be similar to like the income statement type of accounts. So we're going to say that the cash is going to be decreasing. Cash goes down. Other side going to the expenditure. So expenditures down below. Interest being the expenditure, it then going up. Within the government-wide activity, we now have the sales tax earmarked for the debt service collected. So we collected sales tax, and we're going to earmark that sales tax for the debt service fund. So we're going to pay off the debt with it. So if we take a look at that, then we're going to say that cash is going up because we're collecting on sales tax, and that's going to be a form of revenue to the government-wide type of activity. So we're going to credit the general revenue account. If we post this out then in the government-wide activities, we see that cash is going up with a debit. So we're debiting the cash, and then the other side's going into the general revenues. So we're down here in the general revenues for the taxes. It goes up with a credit. What's going to happen to the capital project fund? We're not doing anything with the capital project fund because although the money in the debt service is used for the capital project, this 210 is earmarked to pay off the debt service fund. So if we go to the debt service fund, then we're increasing the cash within the debt service fund, and the other side is going to be a form of revenue. So we have a very similar transaction within the debt service fund, and that, of course, being the increase in cash going up. Other side then going to revenue going up in the credit direction. Next item, we're going to go back to the government-wide activities. We're going to say that there's going to be a billing on the project that we're making. So the capital project, we have billing for it now. We're going to record that in the government-wide activities. This is going to be similar to a job costs type system. The construction work in process then going up, the asset going up, the other side being contracts payable, the liability going up. So if we record this out, we're going to say, all right, the asset we're making, the building, the bridge, whatever it is we're making, it is increasing. Here's the beginning balance. It's going up. Here's the ending balance. The other side then in the contracts payable here is going up in the credit direction. If we think about this and then piece it together in terms of the fund side, we're going to say, well, what's going to happen on the fund side of things? Well, this is going to be part of the capital projects because clearly we're making the capital project here. So we're going to go into the capital project fund, but we're not going to be debiting the work in process because we don't have that long-term asset in the capital project fund. Instead, we'll have to debit some type of expenditures. Not only that, but we'll also have to reverse the encumbrance. You'll recall that we put the encumbrance on the books. We kind of put the expenditure on the books before it was incurred under the modified accrual basis when we signed the contract. So we'll have to do that first. Let's take a look at it. First thing we're going to do is we're going to reverse the encumbrance. We have this encumbrance on the books. This is for the entire contract. So we recorded the entire contract as if it was an expense at the point in time that we signed the contract, kind of like if it was an expense, by putting it into the encumbrance, increasing the debit balance similar to the way an expense would. Now we're going to say that we have incurred what would be like the expenditure related to it, and therefore we need to reverse the encumbrance so that we can then record it where we want to put it after it has been incurred, the expenditure. So to reverse the encumbrance, we're just going to do the opposite here. We have the encumbrances outstanding. We're going to debit that. Then we have the encumbrances. It's a debit. We're going to credit it. This is just simply reversing the encumbrance outstanding and the encumbrance, posting this out, then encumbrance outstanding, debiting it, it going down. Then we have the encumbrance. We're going to credit it, it going down. These two accounts still equal and opposite. They're always going to be equal and opposite. Then we're going to record the expenditure. So now we can actually record the expenditure, debiting the expenditure. And again, this is a little bit unusual because under an accrual basis, you would debit the asset, you would think. But we're debiting the activity, the expenditure here, crediting the payable, and note we're crediting the payable even under the modified accrual because it's a short-term payable. It's related to the construction project as opposed to the bonds payable long-term, not on the modified accrual basis. So if we record this out, we're going to say the construction expenditure is going to be recorded down here. And then we have the contracts payable going up in the credit direction. Well, what about the debt service fund? Nothing's going to happen to the debt service fund. Nothing's going on with the debt. If we go back to the government-wide activity, next transaction, we're now going to say that we're going to pay the contractor. We have the contractors payable here that we have to pay. We're going to pay it now, but we're going to retain 4%. So this is work they've already done. This is money they've already earned, but we're not going to give it all to them because we want them to finish the project. So that we're going to keep some of the money that they've already earned, because that's more likely to keep them around to finish the project. So to do that, then we're going to say that the contracts payable is going to be debited. So here's the contracts payable for the full amount. We're going to debit the full amount to take it off the books, but we're going to put 4% of it, or $64,000, into contracts payable retained, which is 1600000 times 0.04. So 64,000. We're going to keep that. We're going to put it into a different payable. So we'll track it somewhere differently. And then we're going to have the cash will be the difference. So if we record that out, then we're going to say that the contracts payable then going down to 0, the entire thing going down. Then we're going to put the 64,000 to the contracts payable retained portion. And then, of course, the cash decreasing. So cash is going to be up top. What's going to happen in terms of the fund accounting now, if we're paying off the contractor, Well, there's nothing going on with the debt fund. We're going to be looking at the capital project fund. It's going to be looking much the same. Why? Because the contract payable, unlike bonds, is short-term or related to the contract. Therefore, on the books, we're going to pay the cash, and we're still going to retain the $64,000. So it'll look pretty much the same transaction. The cash is going to go down. We're going to pay off the contracts payable, which is on the books for the capital project, it being related specifically to the project, theoretically a current type of liability as opposed to long-term, like the bonds, therefore on capital project. And then we'll have the difference going to the $64,000 for the retained percent. So we're going to say the capital project then going down to 0. We've got the contract payable going up in the credit direction. And then we've got the cash is here, cash is going down. Same kind of activity. Debt service fund, nothing happening here. We're not dealing with any debt. Then we're back to the government-wide activity. We have a grant money received for the capital project. So we got a grant outside of the government entity we're in. Grant is coming in. That's going to be money for us. Cash is going to go up from the grant. It's going to be some type of revenue account. So we're going to say, all right, grant happened. We're going to say cash goes up. And the other side is going to be some type of revenue account. We record that out. We're going to say, all right, cash is going to be increasing. The other side is going to be a revenue account on the government-wide, the accrual basis. What's going to happen to the fund side of things? Well, this money was for the capital project fund. Therefore, it's going to go into the capital project fund in order to make the bridge, the building, whatever it is we're doing there. It's going to look much the same. It is what it is. We got cash. Cash is what it is. And we don't have to give it back, so it's going to be revenue of some kind. So if we post this out, then again, cash going up in the debit direction, the other side going to revenue. Revenue going up in the credit direction. Debt service fund, nothing's happening there. Nothing happened with relation to the debt. Back to the government-wide activity. We're now going to do the closing entries. We're going to say it's the end of the year, end of the period. We're going to close out our accounts now, the temporary accounts, those below what would be kind of like the equity section or the net position, the dark blue accounts here, the revenue and expense type of accounts. We're going to close them out. We're going to close them into the net position account. Fairly straightforward, fairly pretty much similar or the same as we would see in a for-profit organization. We're just going to pick up all of these blue accounts, see what's in them, do the opposite thing to them, in order to make them go to 0. So we have the general revenues. It has a credit balance. We're going to do the opposite thing to it, debit it to make it go to 0. Then we have the program revenues. It's got a credit balance. We're going to do the opposite thing, debit it to make it go to 0. We have the expenses. It's got a debit balance, so we're going to credit it to make it go to 0. The debits minus the credits then resulting in net position of a credit. That's where the difference is going to go. If we post this out, we're going to say, all right, we've got the general revenues. Here's the general revenues. It's going down to 0. We've got the program revenues. Program revenues has a credit. We're going to bring it down to 0. Then we've got the expenses. Expenses on the books as a debit. We're going to credit it, bringing it to 0. And then, of course, the net position, kind of like the retained earnings or capital account, if we're talking about a corporation or sole proprietorship, respectively, it's going to go up in the credit direction. Our post-closing trial balance then, having the asset accounts to liabilities, the assets minus the liabilities would equal what would be similar to the equity position. Here, the net position account. And nothing, all the temporary accounts then gone, those being the kind of the similar of the income statement accounts. If we do the same type of thing for the capital project fund, now we're in the capital project fund, we're going to close it out. You would think it would be easier, but it's actually a little bit harder to close out the capital project fund because we have this encumbrances here. And the encumbrances kind of hang out there because they're not really going to clear out in the same way. I wouldn't think of them as a temporary account. They're kind of a budgetary account. I would think of them as a clearing account because they're really going to stay there until we can record the expenditure, and they're just going to be reflected on the other side in the equity section. So then we're going to go through everything else then. We're going to say, all right, same process for the closing process. Here's revenue. It's got a credit. We're going to debit it to make it go down to 0. This has a credit, other financing sources. We're going to debit it to make it go down to 0. This has a credit, other financing sources. We're going to debit it to make it go down to 0. And then encumbrances, we skip. We're not going to deal with that. We're going to leave it there. It's going to look funny. That's okay. Construction expenditures, it's got a debit. We're going to credit it to make it go down to 0. And the difference is going to go to the fund balance. Now, we're going to break out into the fund balance between assigned and restricted. So we're going to say that $1,100,000 is going to be under the category of assigned, as opposed to the fund balance that's going to be restricted, which is going to be the $770,000. So this minus this, the debits minus the credits, equals the fund balance, the sum of these two, which we further are going to break out between assigned and restrictive, basically reflecting the fact that the assets minus liabilities is the fund balance, and of the fund balance, the net value of the capital project fund, we have the two classes, one being assigned, one being restricted. If we post this out, then we're going to say, here's the revenues. It's going to go down to 0. Here's going to be the other financing sources. Other financing sources has a credit. We debit it, making it go down to 0. Here's the other financing sources again for the proceeds on the bond. It has a credit. We debit it, making it go down to 0. And then we have the construction expenditures. Construction expenditures down here. We skipped the encumbrances. They're still hanging out. This goes down to 0. And then we posted these two to the fund balance for the assigned and restricted respectively up top. So we have the same post-closing kind of trial balance, looks the same. However, we have this one that looks like a temporary account that's not closed out because it's related to the encumbrances, which we don't close out in the same fashion. We just have it reflected up top in the kind of what would be similar to the equity section here. When we do the financial statements, these two, we basically just don't include them. Those aren't going to be included in the financial statements, but they make the post-closing trial balance look unusual if we choose not to close them. If we close them, we got to add them back in typically on the next period, because we want them on the books because they're the holding account before we record the expenditure. Okay, so now the debt service fund, we're going to do the closing process for the debt service fund now. Same type of process. This one's going to be, again, you would think it would be easier than the government-wide activities for a fund, which is smaller, but this one's more complicated in that here we have the budgetary accounts as well as the normal type of accounts. So you'll recall we recorded estimated revenues, we recorded estimated other financing sources, and we recorded the appropriations, which is like estimated expenditures. So we need to reverse those first, and we're going to reverse them to, I'm going to do it first. Probably first is the way we normally. Then we're going to reverse those to the budgetary fund balance. And those should reverse exactly. So once we reverse those, they should be reversed exactly. You'll recall we put these on the books at the beginning, and then we had an adjustment to it. But even that adjustment isn't going to throw things off because we recorded the difference to budgetary fund balance. So when we reverse this, it'll reverse exactly. Everything will go to 0, including what would be similar to the equity type of account. So we're just going to do whatever we have to do to make these accounts go down. Here's the estimated revenue. It's got a debit. We're going to credit to make it go to 0. Here's the estimated other financing sources. It's got a debit. We're going to credit it. Then we have the appropriations. It's got a credit. We're going to debit it to make it go down to 0. The debits minus the credits. Then if we take the credits minus the debits, we get to that $242,000 debit needed to be back in balance. That happens to be exactly, of course, what's in the budgetary fund balance, because again, this will reverse exactly. Everything will go down to 0. We don't have to leave anything in the equity section. So if we reverse this out, then we're going to say, here's the 210. We're going to credit that amount. It has a debit. We credit it, making it go down to 0. Then we have the estimated other financing sources on the books at the 64 debit. We credit it, making it go down to 0. We have the appropriations on the books at the 32,000 credit. We debit it, making it go down to 0. The difference being in the budgetary fund balance. Budgetary fund balance here, it going down to 0. Then we're left with just, like the income statement accounts, and there shouldn't be too many of them because we're just dealing with the debt service fund. So now we'll just reverse out the income statement type accounts, or what would be similar to the income statement type of accounts, the temporary accounts, those that are going to close out. That includes revenue. So revenue has a credit in it, so we're going to debit it to make it go down to 0. Other financing sources has a credit in it. It's kind of like revenue. We're going to debit it to make it go down to 0. Expenditures has a debit in it, so we credit it to make it go down to 0. The difference between the two, the debits minus the credits, being the $242,000, that then going to what would be similar to retained earnings or the capital account, the fund balance restricted in this case. Posting that out then, we've got the 210. So here's the 210 credit. We debit it, making it go down to 0. Here's the 64,000. We're going to debit it to make it go down to 0. We have the expenditures. It's got a debit in it. We're going to credit it to make it go down to zero. The difference then going to the fund balance restricted. That goes up top, fund balance restricted with a credit. And of course, that's what's left over. The post-closing trial balance for the debt service fund is usually pretty sparse, not too much going on there, which means we got the cash up top and then assets minus liabilities, cash minus no liabilities equals what's in the fund balance, kind of like the equity section, the $242,000 in each.